This week in the world of semiconductors, a major milestone was announced that could reshape the future of chipmaking. ASML declared its next-generation high-NA lithography machines are officially ready for mass production, a development poised to accelerate the AI revolution. Yet, despite the groundbreaking news, the company's stock saw a slight dip. So what's causing this disconnect? Are investors seeing something beyond the headlines, or is this simply a pause in a much longer rally? Welcome to TickerWatch News for ASML Week 9, 2026. In this episode, we'll break down the week's top news and developments for ASML, the company at the heart of the global semiconductor industry. We'll explore the technology breakthroughs, financial outlook, and the mixed signals coming from the market. Looking at the stock's performance, it was a mixed week for ASML. The share price closed the week at €1,232.40, marking a slight decline of about 0.5% over the last 7 days. This comes after a period of strong momentum, with the stock up 1.2% over the past month and an impressive 25% year-to-date. Looking back over the last year, shareholders have seen a return of nearly 78%. The slight weekly downturn suggests investors may be weighing the company's high valuation against its very positive long-term prospects. The biggest story of the week by far is ASML's announcement that its next-generation high-NA EUV machines are now ready for high-volume production. After years of development, the company's chief technology officer stated these systems have already processed 500,000 silicon wafers and are achieving 80% uptime, with a goal of 90% by the end of the year. These machines, priced at around $400 million each, are designed to help chipmakers like Intel and TSMC produce more powerful and efficient chips with fewer complex steps. While the tools are ready, the company notes it likely will take customers 2 to 3 years to fully integrate them into their manufacturing lines. Following that, ASML also revealed another significant technical achievement. Its EUV light source can now consistently produce 1,000 watts of power. That's a substantial jump from the 600 watts in current production systems. This breakthrough could increase chip output per machine by as much as 50% by the end of the decade. The company even sees a clear path to 1,500 watts in the future, further strengthening its technological lead over any potential competitors. In its 2025 annual report published this week, ASML signaled a shift in its perspective on market drivers. The company now sees the artificial intelligence boom as the main force behind demand for its products. The report noted that what was once seen as a niche driver is now fueling capacity buildup across a broad customer base, a trend the company believes will continue through 2026 and beyond. Finally, amidst this news of technological leaps and record demand, ASML is also focusing on internal efficiency. The company confirmed plans for a restructuring that includes cutting about 1,700 jobs, primarily in management and IT, to streamline processes. This move, coming at a time of strength, is aimed at sharpening the company's focus on engineering and innovation. Wall Street's reaction to ASML has been largely positive, with caution mixed in. The average brokerage recommendation sits between a buy and a strong buy, with 23 of 29 firms in one survey rating it a strong buy. Several analysts have recently raised their price targets, with a consensus target from one report sitting around €1,397, suggesting roughly 13% upside from current levels. However, the conversation is dominated by valuation. The stock's price-to-earnings ratio is approximately 49, which is above the semiconductor industry average. Different valuation models are giving conflicting signals. Discounted cash flow analyses tend to suggest the stock is overvalued, with one estimate placing its fair value 63% below the current price. In contrast, other models based on earnings multiples suggest it may be undervalued. This division is reflected in community-written narratives, where bull cases see fair value above the current price, while bear cases see it as significantly overvalued. The narrative tone is generally bullish on the technology, but cautious on the stock's rich price, a sentiment echoed by reports flagging recent insider selling as a potential risk to watch. This week's news reinforces ASML's fundamental strengths. The readiness of high-NA EUV tools and the 1,000-watt power breakthrough significantly deepen ASML's technological moat, making it even more indispensable to the global chip industry. Furthermore, the 2025 annual report officially frames AI as the primary sustainable growth driver, giving more weight to the long-term demand story. At the same time, the company's valuation remains the central question. With a market capitalization that has made it Europe's most valuable tech firm, a significant amount of future success appears to be priced in. The announced restructuring and job cuts signal a management team focused on protecting margins and improving efficiency, which could be a response to operating in such a high-stakes, high-cost environment. Looking ahead, there are several key themes to monitor. With high-NA EUV tools now available, the focus shifts to the pace of adoption. How quickly chip makers can integrate these new, more expensive systems into their fabs will be a key indicator of future revenue. This is a process that is expected to unfold over the next 2 to 3 years. Another area to watch is ASML's order book. After posting record-breaking bookings in the fourth quarter, investors will be looking for signs of sustained momentum. The company ended 2025 with a backlog of nearly 39 billion euros, providing a strong foundation for future sales. Finally, a couple of scenarios outline the divergent paths forward. The bull case hinges on ASML's deep competitive moat and its role as a key enabler of the AI revolution, assuming strong revenue growth and sustained demand. The bear case, on the other hand, centers on the stock's rich valuation and near-term risks, including ongoing export controls to China and the potential for a broader slowdown in macroeconomic conditions. That's all the time we have for this episode. Thank you for tuning in to TickerWatch. This podcast is for educational purposes only and is not financial advice. Be sure to subscribe, leave a review, and share this episode to stay informed on the companies shaping our technological future.